Okay, so chapter 13. I think it's maybe the hardest chapter that we're going to cover, um, because the equity section, as we know from the accounting equation, all the action is happening in the equity section, right? In terms of the movement within the business, what it's actually operating and trying to achieve, right? We have assets. Oh, wow. Assets equals liabilities plus equity. But within this section, we have all this stuff: contributed capital, retained earnings. And within retained earnings, it's all the operations of the business. All the revenues and expenses are kind of contained in here. So there's a lot of stuff, a lot of complexity happening here. Okay. And so this chapter, we're now going to look a little more closely at what's happening in that equity section of the balance sheet. Okay. So um, we'll start off with a little review. Uh, the characteristics of a corporation. This is covered, I think, in chapter 1. So we'll revisit that, make sure we're clear on that background, because you don't have, without corporations, you don't have stock. Okay, this whole idea of stock ownership and fractional ownership of a business is based on this idea of a corporation. Okay, so this legal framework that we have to form business entities in, most of the world now, this system exists pretty much everywhere, but it didn't always exist like that. And so I think we should be very clear about what it is and why it's kind of a technology. It is a technology. It's a financial technology, but it is a way uh, of organizing an economy. Okay, so we'll talk about that, review that. Um, Issuance of stock. So there's a little extra detail because, again, this is probably the first journal entry we did, right? First transaction, issue shares worth 20,000 to raise capital, right? That was like the first journal entry we did. So there's a little bit of extra detail we'll talk about. Um, Treasury stock, okay, this topic, when we hear about stock buybacks, a company buying its own stock back from the market, we'll talk about how to account for that, why companies even do it, what is the advantages. Um, so we'll talk about those. Dividends, okay, so again, cash dividends, this is something we've seen since the second chapter, but we'll again talk about more details. There's certain specific events that happen in the declaration of dividends and the paying them. There's also different types of dividends. So there's stock dividends. So we'll talk about what that is, how to account for that, and then stock split. And then these two are kind of related. So we'll talk about the difference. We'll look at an income statement that shows the earnings per share. They actually all do, but we'll just talk, point that out, emphasize that. Uh, Understand what earnings per share is and why it's an important metric. It's probably in some respects more important than the revenue for the whole company. Okay, because an investor, yes, they care about the overall business, but they also really care about the value of their shares. Okay, so the per share metrics are going to matter a lot for that. Okay, we'll again just revisit the equity section of the balance sheet and see how all this stuff that we've talked about ties into that. And then, yeah, we'll just talk about these different metrics: earnings per share, rate of return, return on equity, as it's also just in short form called rate of return on common stockholders' equity, also called return on equity. The price to earnings ratio. So we'll talk about these at the end of the chapter.